The United States is the most indebted country in the world, and right now, it's desperately trying to pressure its allies to keep pumping money into the US economy and help cover its massive debt. What's especially alarming is that America doesn't even try to hide its disregard for the economic well-being of Canada, Europe, or Japan in the process. In this video, we'll focus on the growing tensions between the United States and Japan. The Trump administration is increasing pressure on Tokyo, demanding more and more. But this time, Japan is pushing back. Enough! The message from the White House sounds less like a request and more like a threat. Break your own economy, or we'll do it for you. And now, Japan is preparing a counterstrike, one that could disrupt global trade, shake up alliances, and even threaten the dominance of the US dollar. So let's break down the numbers, the hidden maneuvers, and the real risks behind this clash. We begin with the ultimatum. The US is in a tough spot. Its trade balance is collapsing. The current account deficit has reached 3.8% of GDP, about $1 trillion per year, according to the Bureau of Economic Analysis. That means America constantly needs inflows of foreign currency to keep the dollar from crashing. But trust among foreign investors, including Japan, is vanishing. They're tired of bailing out the US by buying government bonds just to help the White House fund its bloated budget. Now, on the horizon is a 30-year bond sale worth $22 billion in 2025. The last auction raised red flags. The share of American buyers fell to 14%, down from an average of 17% over the past 6 months, according to the Wall Street Journal. Central banks around the world are cutting back on their holdings of US assets, especially bonds. According to the New York Fed, the volume of US securities held in custody for foreign central banks has fallen to its lowest level since 2017. This trend is now being called de-dollarization, and it poses serious risks to the dollar and to US financial stability. Central banks are increasingly choosing gold, euros, or yuan instead of dollars, a sharp contrast to the past when the dollar was seen as a safe haven because of trust in US assets. But now, that trust is eroding. Surveys show that around 85% of central bank managers say sanctions have pushed them to reduce dollar usage. There's another factor: America's massive budget deficits. In the coming months, they may grow by another $3 trillion. More and more people are starting to question how reliable US bonds really are. The situation is worsened by the weakening dollar. In 2025, it lost about 10 to 11% of its value, cutting into returns for foreign investors. All of this puts the US in a vulnerable position. Around 30% of the government bond market is held by foreigners. If they pull out, the US will have to rely on domestic buyers or resort to money printing by the Federal Reserve. That's a fast track to a weaker dollar and rising prices. And higher bond yields will make borrowing more expensive, hurting the economy, while a weak dollar drives up import costs, hitting ordinary Americans right in their wallets. But this isn't just about economics. It's a warning sign that the US is losing part of its global influence. China and Japan are selling US bonds and stockpiling gold. Moving away from the dollar could damage America's ability to borrow cheaply and maintain its leadership role. Some view this as a temporary shift, but the bigger picture says otherwise. If nothing changes, the US could face severe consequences. To avoid a crisis, Washington must cut spending and rebuild trust with its partners. Otherwise, the result will be a weaker dollar, higher inflation, and a decline in US influence on the world stage. Meanwhile, Japanese pension funds are already shifting their money into infrastructure bonds denominated in euros. Why? Because inflation expectations in the US for the coming decades are now above the Federal Reserve's 2% target, and Trump's new stimulus in 2025 could add another $2.5 trillion to the deficit, according to the Congressional Budget Office. The US national debt has already reached 122% of GDP, and there are almost no buyers left willing to keep funding the party. So what is Washington doing? Instead of cutting back, it's pressuring Japan. Raise your interest rates, strengthen the yen. In its June 2025 report on currency practices, the US Treasury said outright, Japan needs to tighten monetary policy to correct trade imbalances. Translated from diplomatic language, that means, make your products more expensive so American goods can compete. Sounds fair in theory, but in practice, it's not. Japan's economy is barely staying afloat. In the first quarter of 2025, GDP fell by 0.7%, exports dropped by 0.6%, and consumer spending, which makes up half of the economy, has stalled completely. These aren't just weak numbers. They're a clear warning that Japan's economy cannot handle further external shocks. Toyota, the symbol of Japan's industrial strength, lost $1.3 billion in just April and May due to Trump's new 25% tariffs on Japanese cars. The company is already bracing for a 20% drop in annual profit. That's more than 1 trillion yen in lost operating income. Mazda is so uncertain it postponed releasing its profit forecast entirely, citing trade instability in the US. This is no longer just a trade dispute, it's an economic war, and Japan is on the receiving end. Trump supporters say he's just trying to level the playing field, but from Tokyo's perspective, this looks like one-sided pressure. Now let's turn to Japan's bond market, because this is where things get truly alarming. Japan's public debt stands at 236% of GDP, the highest among developed nations, according to the IMF. The Bank of Japan owns 80% of all Japanese government bonds, and its balance sheet has ballooned to 126% of GDP. For years, the BOJ kept rates near zero through yield curve control to manage this massive debt. But that policy ended in 2024, and by January 2025, the policy rate had reached 0.5%. In May, the yield on 30-year bonds rose to 3.15%, a record high since 1999. Yields on 40-year bonds climbed to 3.6%. Why? Because markets are convinced the BOJ will raise rates again, not only due to pressure from the US, but also because of the upcoming upper house elections in July 2025 and a planned fiscal stimulus package. But if rates keep rising, Japan's bond market may not survive the shock. Higher yields will lead to losses across the BOJ's massive portfolio. And with spreads already negative, even a sharp but temporary hike could trigger a financial crash. According to Deutsche Bank estimates, meeting US trade demands would require the yen to strengthen by 20 to 25%. That would be a devastating blow to exporters like Toyota, already hurting from tariffs, and could drag the entire Japanese economy into crisis. And here, a logical question arises. Why doesn't Japan simply say no? In reality, it's already trying. Bank of Japan Governor Kazuo Ueda has openly stated, consumer spending is too weak to withstand aggressive rate hikes. Inflation may be above the 2% target, but it's driven by rising fuel and food prices, not strong demand. A stronger yen might slightly lower import costs, but it won't make people spend more. Under recessionary conditions, tight monetary policy would only make things worse. According to a May survey by Reuters, 68% of Japanese economists believe the Bank of Japan should delay further rate hikes until the direction of trade policy becomes clearer. Behind closed doors, the central bank is even discussing postponing its planned bond purchase reductions beyond the fourth quarter of 2025 to avoid triggering a market crash. But Washington isn't listening. Treasury Secretary Scott Bessent, Commerce Secretary Howard Lutnick, and Trade Representative Jamieson Greer can't even agree among themselves. According to Bloomberg, US-Japan negotiations have stalled due to internal disputes within the American delegation. Japanese officials are frustrated. How can dialogue continue if the US position keeps changing? This behavior is eroding trust and making Tokyo question whether it can still rely on the United States as a dependable ally. And now comes the turning point. Japan is not going to simply sit back and take it. Instead of giving in to US pressure, Tokyo is doubling down on the Trans-Pacific Partnership, the 12-nation trade bloc Japan helped preserve after the US pulled out in 2017. In the first quarter of 2025, Japanese exports to TPP countries surged, especially to the Middle East, where growth reached 17%. Japan also signed new trade agreements with the United Arab Emirates to further reduce dependence on the US. Meanwhile, car exports to Canada and Mexico have become major drivers of growth. But Japan is not just talking, it knows exactly how to strike back. Tokyo has already hinted it may begin selling off its massive holdings of US Treasury securities, roughly $1.1 trillion worth. Finance Minister Katsunobu Kato initially said Japan would not weaponize these assets. But in May 2025, his tone changed sharply. These bonds are now on the table as one of our possible tools for pressure. If Japan begins selling treasuries, it could drive up yields, crash the dollar, and trigger real chaos on Wall Street. The April sell-off would look like a warm-up. Yes, Bukado later softened his message, saying no sale is planned for now, but the signal was loud and clear. Japan will no longer play soft diplomacy. Prime Minister Shigeru Ishiba called the situation a battle for national interests. With elections on July 20th approaching, pressure is mounting. He needs to show Japan cannot be intimidated. Tokyo's main demand is the removal of tariffs, especially those on automobiles, the backbone of the Japanese economy. Negotiators like Risei Akazawa have already offered concessions in agriculture and liquefied gas supplies. But Trump's team hasn't budged. Talks have reached a dead end, and Japan is beginning to realize it can no longer rely on the United States. It's time to put its own interests first. Japanese social media is erupting with outrage. More and more people are saying it's time for Japan to go its own way. If Tokyo truly begins a large-scale sell-off of US treasuries, the impact will go far beyond the United States. It could shake the entire global economy. Trump is burning bridges that could take years to rebuild. Japan is not just another trade partner, it is one of the pillars of global stability. By provoking this conflict, Trump is forcing Japan to act in its own interest and to use its full financial power to do so. If the situation worsens, the consequences will be serious, and the US will have no one to blame but itself. What happens if Japan really takes the next step? The global economy could shift overnight. So subscribe to the channel, and you won't miss the next turning point in this story.